I didn't have my sound on. What is up, everyone? It's Bob Freeman here to present you free information, the best free information in the world about the stock market. So, as you can see, I'm not an artist, but I did create a PowerPoint for you guys to organize the information, so hopefully it can be a little bit more clear. So, in our last videos, we already looked at the data we needed to gauge whether or not a sector is likely to outperform the total stock market. Now it's time for us to figure out what companies we want to buy or short sell in the market. Now, we've already developed a fundamental view on the stock market as a whole, whether or not we think it's going to go up. And that will let us know whether or not we want to be bullish or bearish. So if we are going to be bullish on the stock market, we want to invest in a sector that's outperforming the total stock market. But if we want to do even better, we can buy a company that is in that sector that's outperforming the total sector. Now, you should try to avoid at all costs buying a company that is underperforming its sector if you're long on that sector, because you could just buy the sector as an index and receive a larger amount of return for a less amount of risk, because you wouldn't have all of the problems that could happen to an individual company. You're a lot more diversified. You own a small piece of a bunch of different companies in that sector versus just owning a small piece of one individual company in that sector. It should be just self-evident that buying the index is going to save you from a lot of risks that could occur if you bought this. And buying the sector in general is just going to give you a better return. So you want to look for companies that are going to outperform the sector, that is going to outperform the market. You want to stay away from this middle section right here. So, all right, we're going pretty fast. Now, to figure this out, we want to look at the economy. What is that made up of? Now, the economy just is generally made up of the government, consumers, and businesses. Now, businesses are made up in manufacturing and services, and we went over that in previous videos. And manufacturing and services are divided into cyclical and defensive sectors. Now, what this means is, if you're not familiar with these terms, cyclicals are more volatile than defensives, which means that they move around more. They move up and down with the market more than a defensive stock would. They tend to outperform in bull markets, and they tend to underperform in bear markets. Some examples of cyclical sectors are consumer discretionary, communication services, financials, industrials, information technology, and materials. Now, consumer discretionary I put in bold text because I want you to think about that word discretionary, what that means. I think that's a kind of a key word when it comes to cyclical stocks and companies. It's a consumer discretionary is something that someone just kind of buys at their own discretion, like an exercise bike. It's not something that they need, but it's something that they might want. It's a want, but not necessarily a need. What is a bull and bear market? That's a good question for someone who would not know what that meant. A bull market means that the stock market is going up and the economy is looking good. And a bear market is when the stock market is going down and the economy is looking bad. An example would be, right now we're in a bull market. The economy is looking very good. The COVID recovery is looking very good. We are definitely in a bull market right now. We're in the peak of a bull market. Everyone is making money in the stock market. Nobody is losing money in the stock market. Anyone who's getting bullish on the stock market is making money. We are in a bull market right now. Now, a bear market would be like March, what we had in March. Nobody was not a lot of people were making money in the stock market in March compared to now. So uh, the economy was not looking very good in March. So that would be an example of a bear market. Now, cyclicals, I did just go over prior to that answering that question. Defensives. Defensives are just the opposite of cyclicals. They're less volatile. They move around, which means that they move around less than cyclicals do with the market. They tend to outperform cyclicals in bear markets. They don't move down as much as cyclical stocks do, but they do tend to underperform in bull markets. So if the market's looking good, you don't really want to be investing in defensive sectors. You want to be investing in cyclical ones because those are going to be moving up more than defensive are. Just generally, though, generally speaking, there's always going to be anomalies in the stock market that will just do whatever they want. Now, I highlighted again this part, the first, consumer staples, because in general, defensives are things that people need, like energy. People need energy, they need healthcare, and they need utilities. These are things that are always going to be a necessity, no matter what. Even during COVID, for example, healthcare was still happening, energy was still happening. You could still get electricity in your home. You know, these are defensive sectors. Now, the value chain. This is another thing that you really, this is very important to analyze when you're looking at these sectors. Now, every company falls somewhere on the value chain, and summed up, the value chain can be split up into 5 parts. There's the commodity producer, there is the manufacturer, there is the distributor, there is the retailer, and there is the consumer. Now, I'll go ahead and describe each one to you guys. Now, a commodity producer, essentially what they do is they pull a rock out of the ground, or they produce the commodity. That's why we call them a commodity producer. And they need to buy or lease land, labor, and capital in order to do this. An example of a commodity producer would be a mining company that mines for iron ore. Now, a manufacturer is a company that turns that rock that said commodity producer pulled out of the ground, and they turn that rock into a product. Now, a steel manufacturer would be an example because steel is a combination of iron and, I believe, aluminum. And it's required that a company manufactures that. Now, a distributor is a company that distributes these products that were made by the manufacturers among retailers. They buy these products directly from the source, directly from the manufacturers, the people who make the product. And then the retailer, well, an example of a distributor would be a metals distributor, a metals distribution company who distributes metal products to retailers that we're about to go over. Now, retailers, they sell products to the end users. They buy products at wholesale from the distributor. An example of a retailer would be a home improvement store, like, say, Home Depot. At the very end of the supply chain, we have consumers. Consumers have to have disposable income in order to purchase these products from retailers, and they have to have a want or a need for said product. And I really do think that the want and the need aspect really is the key when it comes to a cyclical or a defensive sector. That's a little bit off topic, but a defensive company, a company that's in a defensive sector is a company that makes things that people need, while a company that's in a cyclical sector makes things that people want. But a consumer An example of that would be a independent contractor. They might need to buy metal products from Home Depot. And when you're looking at a sector, you really should just map it out exactly like this, but with more detail. But put actual companies in place of these parentheses. And the companies have to do what a commodity producer, manufacturer, et cetera, does. And by looking at that and looking at what's happening to different companies in these sectors, you can sometimes catch things before they happen. For example, if there is a issue with commodity producers and prices for commodities are going up, well, that might not be an issue for commodity producers, but just say in general that iron ore is going up in price and there's a commodity producer that's just pulling more of it out of the ground because they're able to sell it for more money. And this might be a really, really good thing for the commodity producer and maybe good for the manufacturer because they might be able to get a good deal on that. But after a while, if the prices continue to go up, this could eventually affect the distributor and the retailer and mess up their logistics or just their marketing or their target, how they're trying to sell their product to their consumer. There's a lot of ways that you can see how different parts of the value chain can really affect each other and predict things before they happen in the stock market. Now, so other things that you should consider when looking at companies to buy or sell in the stock market. First, the PE ratio. Now, I should definitely explain what that means. Let's see. Christian asks, lumber prices have been going up. Lumber prices have been going up, and it makes me worried about the real estate industry because, or the more specifically, the home builders industry because they're the people who buy the most lumber, I believe. Now, this could eventually hurt. Again, this is kind of off topic, but this could eventually hurt people like the commodity producer and the manufacturer in the long run. Maybe not in the short term, but in the long term. If people further down the supply chain, the demand gets lower because people don't want to buy as much of it because the prices are higher. But in the short term, it could benefit this side and then hurt the other side. But that's just short term. Now, price to earning ratio, P stands for price, which is the price of the stock, and earnings stands for the amount of earnings that they receive every quarter or every trailing 12 months. As in, for the past 12 months, how much earnings they have received per share of stock. Now, the way it's calculated is they take for the trailing 12 months price to earnings ratio, they take the price of the stock, and then they divide it by the amount of earnings the company made that year total. But that earnings is then divided by the amount of stock that are in circulation. So that way you get the amount of earnings per share for its price. So what earnings really is earnings per share. But earnings per share could be measured over a 12-month period previously, or it could be a projected forward 12-month period, or it could just be for a 1-quarter period. There's different ways to measure it, but for the most part, people use the previous 12 months earnings to measure their price to earnings ratio. And this is probably the most important ratio in the whole stock market, because what this is measuring is how much the market is willing to pay for the earnings of a stock. If one company in a sector has a PE ratio that's really low, and another company in that same sector has a PE ratio that's really high, what that is generally telling you is that the market is willing to pay more for one company's earnings than another. Now, there are inefficiencies in the stock market that will allow us to make money. That's why we're able to make money in the stock market. But the PE ratio is not a way to gauge whether or not a stock is overvalued or undervalued. It's a way to gauge what the market is valuing the company's earnings at, whether the market perceives those earnings as worth paying a premium for, or not worth paying a premium for, worth paying only a discount for. So a company with a high PE ratio in a sector is likely to outperform a company in that same sector with a lower PE ratio. Now, I had some questions in the chat while I was talking about that. I'm going to read those real quick. Even some home builders are just remodeling houses right now because they can make more money off it since the price of lumber almost doubled. That's good to know. That's very good to know. We're going to be looking at the buildings permits report that's released by the Census Bureau later this month, and that will tell us more information about what home builders are doing. But that's good insight. Thank you, Alex. Recently, I've been focusing on really semiconductors. I think chip makers look really good right now. What if a stock underperforms? Does that make us pay from our stock? I think what you're trying to ask, Christian, is if a stock underperforms, do we still lose money? Now, if the stock is going up, but it's underperforming the sector, you are still going to make money because the stock is going up. But you're taking on a lot more risk than you should be taking on, because you could just be buying the entire sector as an index and be making more money rather than just buying a stock, just a piece of an individual company. You could own a basket of companies in that sector that are going to outperform, and that would expose you to a lot less risk because you're just going to have a lot more diversification in your portfolio by owning the index versus owning the individual stock. Now, if the stock is underperforming, as in going down, if you buy a stock and the stock goes down in price and then you sell it, you're going to lose money. So we went over the PE ratio. That was all the questions I had in the feed for now. And now the balance sheet. The balance sheet is a financial statement that all companies release. It's not too difficult to find if you go on their investor website. And what the balance sheet covers is the amount of assets a company has and the amount of liabilities a company has. And what assets are what the company owns and what the company is owed by other people. And what liabilities are is the amount of debt a company has or the amount of stuff that a company owes other people. It's important to look at this in the ratio of assets and liabilities because you want to make sure that the company that you're investing in is solvent. I mean, if a company owes more money than it has and is owed by other people, it's not a good look for that company. That's typically, if you owe more money than you have and are able to pay, you go bankrupt in the long term. So the balance sheet is important to look at because you want to make sure that whatever you're investing in is not going to go bankrupt. Now, again, these things can be looked at more in depth, but I'm just going over them, the most important things I perceive about these aspects. I recommend that you do your own research on these and figure out for yourself whether or not what I'm saying is even true, and also figure out what you perceive to be the most important things about these aspects. Because there's multiple ways of analyzing the stock market, and my way is not necessarily the only way or even the best way. So I'd like to put that out there. I recommend all of you do your own research and not just go off of what I'm telling you. That's just what I perceive to be the most important thing about analyzing a company's balance sheet. There's 1,000 other ways to analyze a balance sheet. Yeah, I'm actually reading a book on how to analyze balance sheets right now, and it's like hundreds of pages long. There's much more about balance sheets than what I just went over. I highly recommend you do your own research on balance sheets, and also financial statements are something you will want to go over in general, not just the balance sheet, but all three financial statements, also the earnings report and the cash flow statement. But I will save that for another video because that would take a lot of time. Some other things you're going to want to consider in the stock when investing in the stock is just commodity prices. These affect a lot of things in the stock market, like we talked about earlier with lumber prices. Commodity prices often affect supply chains and affect the amount of money that companies are making in these supply chains. Now, company leadership is also very important to look at. You want to make sure there's no scandals going on. You want to make sure there's no fraud. You want to make sure there's nothing fishy going on. And another thing, just in general, no matter what you're looking at, you want to look at just what the government is doing. And you want to keep in mind that generally the government doesn't drive what the economy does. Typically, the economy does things and the government reacts to it. Their policies react to what the economy does, and they also have a lot of other motives that aren't necessarily to help the economy or to help people, but just as far as special interest goes and looking good to the people who are electing them. And just keep in mind that the government doesn't drive the stock market. In a way, the stock market or the economy does things that causes the government to react. Use the stock market or use the economy to predict what the government is going to do, but don't use the government to predict what the stock market is going to do, because politicians will say anything to get reelected. They just lie. So, I guess use this economy to predict what the government is going to do in reaction to the economy, and also gauge consumer sentiment to figure out what the government's going to do in reaction to how people are feeling. And then, off of what you predict the government is going to do in reaction to the economy and to the consumers, I guess then you could predict what, in turn, the economy is going to do. But at the end of the day, that's just too much work, guys. I mean, if you stick to all this other stuff and just ignore what the government is doing, or just have a general idea of what the government is doing, you're going to be fine. You don't have to do all of that. Sorry, that was a bit of a rabbit hole. So, how the heck do we calculate one company's performance over another? And how do we figure out if a company is outperforming or underperforming its sector? And how do we figure out if the sector is outperforming or underperforming the market? I mean, how do you even figure this stuff out? Obviously you can look at the monthly performance as a percentage number and the yearly performance as a percentage number, but how do you analyze this on like a chart, like one company's performance relative to another's, or one company's performance relative to the entire sector's, or one sector's performance relative to the entire stock market? Well, I'm going to show you exactly how to do that right now for free. Wow. Okay. I apologize. I'm actually gonna grab some water because I'm extremely thirsty right now. But I will be right back in exactly probably 30 seconds. I promise it will not take long. Thank you. All right. I hope that was not too long. Uh, sorry about the wait. So all that we have to use to do this is this website, Yahoo Finance. Anyone can use it, and we're going to use Microsoft Excel. And it does cost money, but there's plenty of ways to get around that. And I'm not gonna, that's not my job to teach you how to do that, but you can figure that out for yourself. I am a student at a college, so I get it for free that way. But you are welcome to do your own research to get Excel however you want. Just don't tell me about it. So first, we're gonna look up what the total stock market is doing. So for the S&P 500, it's just S&P 500. We'll type it in to the search bar. My computer is very slow because I use a Mac. I apologize. Click search. Wow, I could have clicked it right there, but that's okay. Now, this is the S&P 500, and what we want to do is we want to click on historical data. I'm sorry, this is going to take a while because my internet is slow. Or my computer in general is slow because I'm streaming. All right, what I'm gonna do, I'm gonna close out PowerPoint. Maybe it'll run faster. Let's see. Sure. Sorry for this wait. Um, I really should invest in better infrastructure. Wow, this is tragic. Perfect. So we have historical prices for the S&P 500 here in Yahoo Finance that we found just by searching it. That's what I needed to load. Now for the time period, I'm going to just do the maximum and apply. And I believe it has loaded. I hope. We're going to select all of the data. We're going to copy it. I think that selects all of it. Now for perfect. What I'm actually going to do is I'm going to put the frequency to weekly because it's going to take way too long to load the frequency for daily on my computer while I'm streaming. But it will show us roughly the same thing, and it's the exact same process. We're just using weekly data instead of daily data for the price of the stock market. So weekly, why? And this will give us a much shorter data set because that's only gives us an interval for every week instead of for every day. So hopefully this will load a lot faster and it will be easier for me to show you guys. I apologize for the slowness of my computer. It used to allow you just to download it, but I don't believe that is an option anymore. They don't have a download link for me to just download this data. I think it's copied. Let's see if this works. Perfect. That is not all of the information that we needed. But we're just gonna do that. We'll take the data from a limited time frame just so I can give you guys a general idea of how to do this because the process is really, really easy and there's no need for me to spend that much time showing it to you guys. So you want to delete everything that you took from the prior screen except for adjusted close and the date. And then the adjusted close is what the stock closed at the end of the week or at the end of the interval that you selected, whether it was the week or the day or the month. So I'm going to delete these rows so that way they're nice and together. Oh, wrong one. So I'm going to label that as the S&P 500. I'm just going to put S&P because it's not really another S&P that I personally care about. Maybe others do. Now, we're going to compare it first to just semiconductor sector. And we're going to use the ETF, Van Eck Vector's semiconductor ETF, to track generally how semiconductors are doing as a sector, semiconductor companies. So we'll do the same thing. We'll go to historical data. And frequency, you have to do the same frequency for both of the things that you are comparing when you do this. I'd recommend that you do daily, but for the purposes of this video, we are doing weekly because we don't have time for daily data to load. We might not even have time for weekly data to load, but we're trying. Okay. Weekly. Max. Apply. Wow, there's the download link that we needed. Perfect. So what you normally do is after this is loaded, you click the download link to get the data, just immediately download it onto your computer and export it into a spreadsheet, and it's a lot easier to deal with that way. So we're going to do that with this one because, wow, it's weird. Should be available. We're not going to, but if you are blessed enough to have the download button when you use Yahoo Finance, use it because it's a lot easier than doing this. But doing this is really not that hard either. It's pretty simple. So we copied it and we pasted it here alongside the S&P 500 data. And we're going to do the same thing. Oh, sorry. We're going to delete everything except for the adjusted close data and the date. I hope that is enough data. Yeah, we're perfect. Now this one includes a dividend that we're going to have to delete because that's just a repeated day, and it makes it so that way this data set and the other data set don't align. So pay attention if you have a company that, or a sector that has a dividend. You can get rid of that by right-clicking it and pressing delete. Okay. And also, I'm very, very sure that there are more efficient ways to use Microsoft Excel, but I don't do anything very fancy on it, so I really don't know much about how to use it as efficiently as possible. It's something I'd like to learn more about in the future, and I think it's a really, really useful skill, but it's not something I've had the time to do right now. But it is something I'd like to do in the future, because I think if you're very efficient at Microsoft Excel, that can be useful for a lot of different things. Not even just this, but for a lot of other things as well. Okay. delete, delete. Perfect. Now, as you can see, this data is aligned, so there's no need for us to have this second set of dates. It's totally fine as is. And we don't need this number either. We don't need to see the volume when we're making this chart. So rather than deleting all of the cells in between, it would actually be a lot faster if I just copied this. Then I pasted it next to it and deleted this one. So this represents semiconductor manufacturing. And the way we will compare both of these is we'll see how semiconductor manufacturing, SMH, is over the S&P 500. So what this will measure is how much this grows compared to this. Simple enough. Now, the formula is exactly what you see above in cell E2. It's the SMH, the close for that week, divided by, or the close for that interval, whatever you're using. I recommend daily, over the S&P 500. Now, this will give us, wow. Sometimes this will happen. If your cells are formatted incorrectly, you'll have a number, but it will give it to you as a date. Now, to fix this, this is something you really want to know, because this can be really frustrating if you don't know how to fix it. You right-click on it, you press Format, and in time, this will pop up. Not custom. You just want it to be number if you just want it to be a number in that cell. Otherwise, weird stuff could happen. So just keep that in mind if you type in a number and it turns into a date and you don't want it to be a date. Just format it as a number instead. Make sure it doesn't have any weird formatting in that cell. So that gives us a number there. And what we want to do is we want to put this formula in every single cell. And so I'll go ahead and show you the easiest way to do that. You'll go to the bottom, and you want to select the bottommost cell, and you want to press Command-Shift if you're on a Mac, or I guess it's Control-Shift if you're on a Windows computer or a PC. And then you want to press the up arrow, and it will highlight all of those cells, that entire row, up until the next thing that you had typed. And then Control-V or Command-V to paste, and it will put that same formula in all of those cells. Oh wow, this is going to be a really ugly chart. Now, because we don't, for just purposes to save time, we didn't even get a full year's worth of data. So interesting to see how this chart is going to be. Now, after you've calculated this, you want to put these numbers on a plot with these dates. And what that'll show you is how much semiconductor manufacturing industry is doing compared to the S&P 500. If they are overperforming or underperforming. You're right. I should add some decimal points to that. That's a very good idea. Again, it's a very similar process. This is a very similar process to how we formatted to get it out of date format. You would format the cells, and it will give you an option for the amount of decimal places you want. And let's do 7. That would be crazy. Wow. Sometimes you have to scroll around for that to load, or at least on my computer. Probably not on yours. I have one of the worst computers. So maybe we'll have a better looking graph with these decimal points. Now, I'm going to delete this row. We don't need it. And what we're going to do is we're going to copy all of this, not copy it, but select all of it, except for that bottom row. Go to Insert. And you want to make a line chart. Now this is not complete. You want to right click it and click on Select Data. And as you can see, we don't have a horizontal axis. So for that, we'll put in the date squares. I'll select all of those. Only the ones that correlate with the numbers that we typed. So, okay, there we go. Now, what this will show us is how much the semiconductor industry is doing, how much better they're doing compared to the S&P 500. And we can see that it's an uptrend. And it's recently taken a dip, but it's starting to go back up. So this is a good chart to look at if you want to see how semiconductor manufacturing is doing compared to the general market, if it's overperforming or underperforming, just trend-wise. This is just how you look at the price, not this is how you generate ideas or study the fundamentals, but if you want to just see what the price is doing compared to the market, this is how you make the chart for it. I don't know of any program that lets you do that, to be honest, other than maybe the Bloomberg terminal will let you do that. I know that, but it's a lot of money. Now, if we want to see how one company is doing over the semiconductor industry, we would type in just a company in the semiconductor industry. Let's do AMD. That's a very popular company. Now, AMD has a very, 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 very high price to earnings ratio. It's very high. Or it was. It's not as high as it used to be, but it's high. And compared to another company that is in the same sector, say Intel, Intel has a very, very low price to earnings ratio. The market does not perceive Intel's earnings as valuable compared to AMD's, but I don't have to pull up a chart for you to know that AMD has been outperforming Intel for the past few years. And people on TV will tell you, buy Intel. Buy Intel. It's so cheap. The price to earnings is so cheap. You're getting so much earnings for what you're paying, but you'd underperform the sector. You'd underperform the market. You'd underperform everything else. Now, I'm gonna stop there. I've spent a lot of time doing this, but you get the idea of how to do this. All you'd have to do to figure out what company is outperforming in the semiconductor sector would be look it up and do this exact same thing, but except you would put the semiconductor company you're looking at over the semiconductor industry versus the semiconductor industry over the entire market. And then you'd make a chart, figure it out. But first, you want to make sure that the sector you're looking at is outperforming the market as a total before you look for companies that are outperforming in that sector. Now, I see I have some questions. I'm going to go ahead and try to answer those. Sorry, I got a little bit carried away. If you really wanted, you could graph each chain of the value chain for semiconductors into that graph to see which chain outperforms the sector. Yes, yes, I do. I see what you're saying. I see, and then, or I guess it would have to be specific companies within the specific chain. Now, you might want to, when you're mapping out this value chain, I took on the PowerPoint, but what you want to do is there will be like a sector, and it will be broken down into a value chain, and the value chain could be spread across different sectors, but you want to map out where your sector that you're interested in is going to where the companies in that sector are going to fit on the value chain. And there might be multiple companies in a sector that fit in one place on the value chain, but there's not really a good way to invest in them as a basket. I mean, I guess you could buy like a share of each one or something like that, but I'd recommend just analyzing the companies individually and just settling with which one you think is the best one and not putting that much stress into it of doing research on multiple companies that are in the same part of the supply chain and then buying all of them. I think that would just take too much. It'd just be too much of a hassle. I mean, if you're willing to do that work, do it. But in general, like you should really just invest in one. There's no need to invest in multiple companies that are in the same part of the supply chain in the same sector. If that makes sense. If that answered your question. You just want to invest in one constituent of that part of the supply chain. You don't want to invest necessarily in every single company that falls under it. Now, I've been doing this for 50 minutes, so if you guys have any more questions, I'd be happy to answer them. But if not, I'm going to head out because I actually have a lot of work I have to do for school, and I'm going to do another video tomorrow, and I have class tomorrow. So in general, there's just a lot of things that I need to do, so I can't carry this on forever. I apologize. But if you have any questions, I'd be happy to answer them. But if not, I'm going to have to go and just do the things that I need to do because I'm a busy man. I major. That's a really good question. What's funny is like the most fried answer to that question. Like, I want to major in finance. However, right now, I'm just going to community college, and I'm taking a psych class and an English 101 class, and all of the stock market stuff. I just learned it on my own. I'm just genuinely interested in the stock market. That's why I want to major in finance. But I don't think there's any point in going and paying for like 4-year university prices and like right now and taking school online, because right now in community college I'm not learning anything in online school, and if I were to transfer to a 4 year, I mean, it would be the same thing, just 10 times as much money, and I'd be wasting more time because there's classes I really want to take in person because I actually have interest in the subject. I just want to get the piece of paper so I'm qualified to actually work in the field. But right now, I'm not. I have no qualifications at all. I'm just a student who has interest in this. So all I'm doing is just trying to share the information that I've learned so far, and hopefully it could help other people. If I learn more information in college that I can share with you guys, I'd be happy to share that though too in the future. Yeah, you can definitely learn more college doing this than you ever, or you could definitely learn more doing this than you ever will in college. I agree. Like, and you kind of go to college to it just fills some gaps, you meet new people, it opens your mind to a lot of things that you wouldn't have really thought about otherwise. But at the end of the day, there's a lot of majors in different things, but people get hired because of what they're good at. Besides that, that just kind of shows that a piece of paper, all it does is says like this person is generally qualified. But people aren't going to want to hire you if you're just generally qualified. They are going to want you to be good at something, not just be generally qualified. That's not impressive. Um, like, what's more impressive is the amount that you've learned outside of school, whether it be through studying other things, through other resources on your own, just out of genuine interest, or just through experience in the real world and real life, through real work and real experience, all that. You got to get some private investors and start doing your own stuff with the stocks. Maybe. We'll see. You never know. You never know. I mean, 2 years ago, life was very different from how it was now, and 2 years ago from then, even more so. So, yeah, you never know. I mean, maybe one day, but I don't see it in the foreseeable future. It could happen, but I don't see it in the foreseeable future. But it could happen in the future. But I was just like, I have no plans of doing that. I guess that's better words to say. No plans of opening a private fund right now. Yeah, going to college and getting a good GPA basically means that you can follow orders and have the ability to learn things well. Not much practical stuff you can take away. Yeah, I mean that can be true, but a lot of it depends on your major and if you actually care about what you're learning. And I don't know, it's pretty subjective. I mean, it's not just like every person who goes to college, like all they do is learn this and this. It's pretty like person to person, you know. I mean, some people, yeah, they go to college and all they learn is one thing, but there's plenty more people I think who go to college and they learn many more than just what they learn in college. Uh, that could be the opposite, actually. Who knows? Thanks for making a comparison to me and Dr. Michael Berry. Okay, on that note, I'm gonna have to head out because I think we're just having too much fun here now. uh, there's not too much work going on, and I need to start doing some work. So, hope you guys all have a great day. Um, I will do another live stream tomorrow at 7 o'clock p.m. where we will go over initial and continuous jobless claims. And what that will tell us is it will confirm or deny whether or not those reports we saw earlier about employment are going to carry on into the future. So if we look at the data and it tells us everyone's just starting to file for unemployment again, then obviously the employment problem isn't as much solved as we thought prior. But I have a feeling that we're not going to get anything too startling in the data. However, you never know what might happen. So we'll see. We're going to look at it anyways. And I think employment will be fine, but we're going to look at it just as a good weekly checkup of our economic situation. So I hope you guys all have a nice rest of your day, and I will see you tomorrow. Peace.